And right now, stocks are mixed. Major averages you're taking a look at on your screen here. We've got both red and green territory as the Dow right now is down by about 0.7% and fractional declines for the S&P 500 as well. The Nasdaq holding on to gains just barely. This all as it is a huge week on Wall Street. Investors digesting new data out today. PPI, a measure of wholesale prices showing evidence that inflation is moderating. This comes after May's consumer price index, CPI, as you know it in your household and in your hood, perhaps. We also saw that showed inflation cooling. But there are still some sticky areas of inflation, and the Fed is now projecting only one rate cut for the year. So here to break down what this all means for your investment portfolio, we've got Burns McKinney, who is the NFJ Investment Group Managing Director and Senior Portfolio Manager. Great to have you here on the program. So, as you're really digesting all of the data that's come out over the course of this week, what is the portfolio playbook that you are pondering or perhaps even enacting right now, Burns?
Well, there certainly has been a lot of very important economic data, and that was a great explanation that we just received on the Fed's dot plot. And one of the reasons we take a little bit of what they do with the dot plot with a grain of salt is that a lot of what the Fed governors are doing is also trying to manage investor expectations. For example, it's easier to suggest maybe we're only going to have one rate cut and then surprise the market with two rate cuts than it is to do the opposite. I was on a road trip with my family over the weekend, and I thought the drive might take 4 hours, but I suggested, well, maybe we should expect about a 4.5 hour drive to my family just to kind of help manage those expectations and bake in some room for contingencies. And, likewise, we had, with the CPI print, that was fairly dovish. Inflation is pulling back, and we do expect that the Fed should get room to cut rates later this year. That said, with respect to your question about how investors should position portfolios, we do feel that interest rates, whereas they may be pulling back some, they probably are going to remain a little bit elevated relative to what they've been over the last 10 or 15 years. And so as a result of that, with a little bit higher inflation, a little bit higher interest rates, we're suggesting investors should put their portfolios into shorter duration instruments, areas where you're getting your cash up front and then you can reinvest it. And that makes a great case for stocks and companies that are paying dividends, and really especially companies that are raising dividends, because dividend growth oftentimes is faster than inflation.
Are you seeing investors pile into a few specific names with that theme in mind?
Well, the beauty of it is that investors really haven't gotten there yet. This has been very much of a risk-on market. You still see investors really flocking to what's been working over the last year, which has been your Magnificent Seven and your big high growth tech names, which tend to actually be the opposite. They're a little bit longer duration, and they've been flocking to those. And what we do expect to see as the Fed starts to maybe finally get a chance to lower interest rates is a little bit of a broadening of investor returns, a little bit more breadth towards away from that Magnificent Seven and towards maybe some of that mundane 493, some of those areas of the market that have lagged over the last year, despite the fact that earnings have continued to grow. And as a result of that lagging, you get better valuations than we've had in quite some time in some of those other pockets of the market.
And so with that in mind, as you're thinking about and evaluating some of the forward earnings that you are hearing from companies, what does that spell out for what investors should be expecting as we get into the second half of 2024 and then look even further out to 2025?
We're certainly seeing signs of, despite the fact that inflation's pulling back, we have been looking at a little bit of a Goldilocks type scenario whereby economic growth has been very resilient. That said, some of the Fed rate hikes that we've seen over the last couple of years are starting to have a maybe slower than expected impact, but nonetheless an impact. We've seen unemployment climb to, it's still at historically low levels, but it's starting to come up a bit. You're starting to see, rises in consumer credit card debt. And so, we feel that the economy is probably slowing somewhat, but nevertheless at a sustainable pace. And as a result of that, between that and the fact that investors have been treating things very risk on, I think that the mantra has been mission accomplished with respect to having a soft landing from these hikes. And so as a result of that, people have kind of moved away from some of the defensives. The way sort of you can think about it is that when the sun is shining, people aren't going out buying you can actually get umbrellas at a reasonable price. And so, some of those umbrella type areas of the market, would be things like some of the defensive areas, things like utilities. They've lagged over the last year, and as a result of that, you get great valuations, you get attractive dividend yields that again help investors keep up in an inflationary environment.
Burns McKinney, who is the NFJ Investment Group Managing Director and Senior Portfolio Manager. Thanks so much for taking the time here today, kicking off the show with us.